Hello, everybody. My name is Mark Fonville. I'm the president and a wealth manager here at Covenant Wealth Advisors, and I welcome you to our presentation on investing in uncertain times, inspiring perspectives on the 2020 stock market decline. And I want to thank all of you for attending this presentation. And I really mean that. And the fact is, you are taking time to educate yourself for the benefit of you and your family's financial security. And I think that's a big deal. And we do all think that's a big deal here at Covenant. And for all of our clients who are watching this as well, we're honored and grateful to have the opportunity to be your guide in your life toward your financial goals and life goals. I'm sure you don't have to be told that we, and I mean not just investors, but the country and the world, are certainly in a big, awful mess, or so it appears. While this isn't the first time this has occurred, as history tells us, there have been many times we've been in an awful mess. The COVID-19 virus has disrupted everything: the health and safety of us and our friends, relatives and clients, the economy, and investor portfolios across the world. And it reminds me of stories my grandparents told me about the Great Depression and World War II, which basically, they were a story of collective sacrifice as we faced great and sometimes mortal threats. And of course, my grandparents survived it, or else I wouldn't be here, of course. And we both know that our society will survive this as well. I'm presenting today, not because markets are down, as that occurs on a regular basis, but because I deeply want to comfort you, lighten your load a bit, and make it clear that you have an experienced team to help guide your financial decisions when and if you need us. You're not in this alone. So let me offer these thoughts. Taking on the worries of friends and family is certainly hard enough. And taking on those same worries, along with a financial decline, at a time when it may appear that there are few real actions that can be taken, can be unbelievably stressful. My request is that you practice self-care, exercise, eat well, and periodically remind yourself that focusing on what you can control is sometimes the best antidote for stressful situations. Second, recognize that you're part of the human herd. By that, I mean that you probably have the instinct to sell and get out of the way of whatever the market does in the unpredictable future. You can create certainty by retreating to the sidelines, as I know some investors have considered. I know you're telling yourself to be rational through this crisis and focus on the long term, but you should recognize at a deep level that you, yourself, are not immune from the outcries of the irrational, instinctive part of your brain, which scientists tell us is the most powerful, most especially in times of crisis. This is precisely why investing is not easy. Scientists tell us that the human brain has three parts: the cerebral cortex at the top, which makes us rational humans; the cerebellum below it, which has the intelligence of a rabbit, coordinates muscular activity, and which makes us emotional creatures; and then the limbic brain at the top of your spinal cord, which controls fight or flight reactions. This bottom nodule of thinking tissue has roughly the same intelligence as, yes, a lizard. And don't be offended, mine certainly does too. Now, when humans encounter danger, and the recent market behavior certainly qualifies, particularly when it is also associated with a life-threatening pandemic and global economic shutdown, the mind instinctively retreats to the limbic brain, which means that, without trying to add too much humor to a very serious situation, most of us during times of crisis process information with the intelligence of a lizard. Well, my goal with this presentation is to elevate our collective thinking, so when the dust all settles, you look back on this crisis and feel confident about the decisions you've made. In the end, regret is a powerful force, but my experience has taught me that education and advice is a great way to improve the chances of making better decisions. And ultimately, our goal at Covenant Wealth Advisors is threefold. And it really starts with having a plan that's right for you. So where do we start? Well, the first step in that process is designing a plan that's based on what you want to accomplish going forward in the future. And that may involve a lot of things, and we'll talk about that here in a moment. But it's really creating the blueprint for your finances and your future and your life. The second thing is actually implementing or building that plan. The implementation may begin with the first plan that we draw up, but that implementation is a lifelong trek, and it's something that needs to be updated on a regular basis. And then finally, it's protecting that plan. And that kind of goes in line with building it, but protecting may mean making adjustments as your life changes, making adjustments as finances change, making adjustments as market change. And so that's our process, and that's where we begin. And I think that's a great foundation to start with, particularly when it relates to the question of what should you do with your money. Now, in times of crisis, there are lots of different thoughts and obstacles that you will encounter. And the first one is, will you be swayed by the media, right? The media, it can be very powerful in its headlines and the messages that are communicated. And those messages aren't necessarily built for advice, but rather to stir up fear and greed. So you keep on coming back for more and more headlines, buy the newspapers and watch the Fox News and the CNBCs on the television. However, if you go back far enough, back in 1970s was a pretty treacherous time for a lot of people. That decade began with a horrific recession in 1973 and 74. And by the end of the decade, people had lost hope really in really building wealth over time. There was a Business Week article that came out that had the headline, "The Death of Equities." What if you saw that at that time? What would you have done as an investor? Would you have sold out of your portfolio because they were professing that perhaps the growth of markets is over, right? Well, what we know now, of course, is the next several decades would be some of the best decades in investing history. But certainly you wouldn't have experienced that had you succumbed to the headlines of the day. And so the first thing, the obstacle that you need to be aware of is that the media and headlines, they're your enemy, and we have to take them with a grain of salt. But they can be convincing. And so a lot of the things you'll read and the questions that will be raised is, can we predict the future? Should you be able to predict the future? Should your financial advisor be able to predict the future? Should someone have told you to get out of the market 4 weeks ago? And certainly while we would have all enjoyed that bit of advice, unfortunately, it was very difficult to actually see that advice at the time until we actually looked back, and not many people were saying that. I haven't met one really quite yet. And then the trick is when you get out. So thoughts like, I have a proven system for picking stocks. You're going to hear that. You're going to see that. You're going to hear people say, gosh, get in this sector of the stock market, or get out of another area of the stock market. And just be aware that the idea of predicting the future is certainly a real feeling that you may end up having, but ultimately predicting the future is nearly impossible with any bit of skill. And then the third here is, do you act on impulse, right? And some of the thoughts that we're hearing now are, gosh, I can't stand this bear market. Should I be getting out? Now, thus far, none of our clients have actually gotten out. You have all stuck with the plan, and that's been a wonderful thing to see. That we think that's the right thing. But there are going to be impulses with emotions as we go through the ups and downs of this stock market decline. But if you're aware of those three things, I think it's a good starting point. So the next question, and this will be a series of questions that will help answer for you, is why invest in the first place, right? What's the importance of it? Why invest? Well, investing starts, as I mentioned, with a plan. So as it relates to your goals, the goals aren't just about having more money. In fact, I've never really spoken to anybody, at least any of our clients, who say their goal is to have more money. Rather, what it comes down to is they want financial security, they want good health, they want to provide for their children, for their spouse, for their family, they want a great career. They want to get satisfaction out of the work that they do. They want to give to others, give to charities, give to their church. They want to be a part of the overall society. They want to experience life in a way where they don't have to worry about the stress of money. And to accomplish all of those things, you can do it blindly by reacting to the market, or rather what we recommend and what we're big believers in is you create a plan that's personalized for you in your family. And that's really why you invest in the first place. And so when you get from point A to point B, the end result is you want to do it in a way that helps you avoid running out of money, right? That's kind of the primary objective here. The other reason that we invest is simply that the cost of goods increases over time. We call that inflation. And so one powerful example of that is if we look back many years ago, 1918, a quart of milk cost 14 cents. Fast forward to 1968, 2 cups of milk cost 14 cents. And then by 2018, 14 cents only bought you 12 tablespoons of milk. And while I think a lot of you may have children, or certainly you grew up around kids, or you have grandchildren. We've got 3 children at home, one 12-year-old, a 10-year-old, and a 4-year-old, and I can tell you they go through a lot of milk. I wish it cost 14 cents, but it doesn't. And so the point here is that costs rise, and you need to make sure that your wealth keeps up with those rising costs. Some things rise faster than others. For example, healthcare. Healthcare costs are rising much faster than things like clothing and groceries. And so that is an important aspect of investing, and why most people understand that we just can't keep our money in cash. Although that would be a wonderful thing if we could, certainly if we were wealthy enough to do that, or simply there weren't any inflation in the first place. So you add all this together, right? And with your plan, what you're trying to do is you're trying to figure out, okay, what's the likelihood of accomplishing your goals? And this is a fairly new phenomenon in planning, in that we can get a good idea for every family that we serve. We can actually give you the probability of the likelihood of accomplishing what's important to you, including crazy outcomes like we've just experienced over the last several weeks. And we account for these ups and downs in the market in these plans. And so that's kind of one of the wonderful things about technology, is that we're able to do that now. Now, certainly nothing's guaranteed, but what it's all about is improving the chance of success, improving the probability. While there's no absolute outcome, there's certain key areas that we can focus on, that you can control as an individual, that increase your chances of success. But like anything, right, there's no guarantee. And it's synonymous with, if you went to a nutritionist, the nutritionist is going to tell you, hey, I think that you need to exercise more. These are the foods that you need to eat, perhaps different vitamins that you may need to take. And if you do these things, you're much more likely to lead a healthier life and maybe a longer life. But what that doesn't guarantee is it doesn't guarantee that you won't wake up, or tomorrow, the next day, you won't have a heart attack. And I think investing is very similar, in that we can focus on the things we can control. There's certain things we can't control, but let's just focus on the game plan that we have nailed down. So with that saying, the next question we want to answer for you is, what does history tell us about stock market declines and recoveries? I think that's important. While history never repeats itself, it certainly does rhyme. And one of the statements that I hear a lot of times from investors is that, hey, Mark, I really feel like it's different this time. This is just a different scenario. And the truth is, the COVID virus is a different scenario. But the good news is that it's always different. Everything is always different. Going forward, we'll encounter things that we've never encountered in the past. But if we look at history, that'll give us a good indication perhaps of where we've been and maybe what will be mirrored going forward. So let's dive into that for a moment and take a look over the past 25 years or so. What you see in front of you is a popular stock market index called the S&P 500. It represents the price movement of the top 500 largest US companies in the United States. So it's a good proxy for what the market is doing, although the market isn't just the US. There are many markets across the world, but this is what we typically see in the press and in the media, and we certainly use this behind the scenes as well. But what you'll notice is that the market over the last 25 years has gone in an upward trend. There have been 2 major recessions, and likely we're in one now. So perhaps 3, right? Over 25 years, yet markets went up. And the reason that markets went up, we believe, is that all markets are a collection of great ideas, right? It's someone like you, someone like me, who wants to solve a problem in society. So we create a service or a product, and we offer to people who are willing to pay money for it. And then when the idea gets big enough, we may create a company, and that company gets big enough, it goes public. And when it goes public, as the owners of the company, we get money from investors to help continue to grow it. That's what investing is all about. And great ideas will always abound. They will always exist. And people will always want to make lives better. And really, from a high level, that's why markets work in the grand scheme of things. So here we are. We've had this massive decline. So what does that mean? Historically, is that normal to see a market fall off like this? Here's another way to look at it. So this goes back to the last 30 years or so, and each bar represents the global stock market returns. So this is actually a much more diversified stock market index, more diversified than the S&P 500. And it shows the returns of this index for each calendar year. And then the red dot shows the intra-year decline for the market before it ended where it ended up or down for the year. So what you'll notice is these are the max drawdowns for any given calendar year, and they're quite substantial. So for example, if we go back in the early 2000s, markets dropped 20%, 32%, and 31%, 3 years in a row. And that was the worst drawdown, right? And markets always ended up a little bit better than the worst drawdown. But I think it's interesting because it reminds us that market pullbacks are actually something that happen quite frequently. And of course, we've seen a rebound in the current market. It went up considerably yesterday. That would be Tuesday. And then today, currently, it's up a little bit as well. So interesting perspective that market declines are very normal. What about the longer term? So let's take a look at a similar chart, but let's go back to the Great Depression. Again, we see most of the years are positive in returns with the blue bars. Obviously, some negative years. You'll see this is the Great Depression here. And then again, the blue circles are the intra-year max drawdown for the stock market in any given year. And again, you can go back, and yet we had substantial drawdowns. For example, back here and I believe this is probably around 1929, 30, 31, drawdowns of over 50% with just stocks. The average intra-year decline, by the way, for the stock market, 15.5% decline in any given year, going back, many, many years before the Great Depression. Okay, well, what about going forward? Do markets rebound? Well, the interesting thing is the only precedent on diversified markets is that they have always rebounded. In fact, they have never not rebounded. If for diversified portfolios, when we look back over time, they have always come back. Now, that's not to say people don't lose money, but people lose money for a different reason, and we'll address that a little bit later in the presentation. What you see in front of you are the top 25 stock market drawdowns going back to the 1920s. So you notice the Great Depression from peak to trough, the high point to the low point, in 83, almost 84% decline. The second worst was a 54.7% decline. The next was 50.8%, and so on. So we got to around right here. As of today, we've trends back a little bit, maybe toward the middle here. The second bar, by the way, is the subsequent uptick in return for the market after we hit that low point. So the subsequent 12-month period, what the market did over that time. So you notice after each bottom period for the market again rebounded. That's happened in history. So you have to ask yourself, if you have a decision to stay invested or to pull out, well, there is no precedent that markets didn't recover assuming you're diversified. And that is a big assuming you're diversified. For our clients, we believe all of our clients are, but for a lot of investors, they may not be. So if you go against that precedent, what you're saying is that you as an individual know something that millions of other investors don't know. You might have a gut feeling, but unfortunately that doesn't lead us to any valid conclusion going forward. Our suggestion is that markets have rebounded in the past, they're likely to rebound going forward. While there's no guarantee, that's what we believe with a high degree of probability. What's another way to look at this? Well, what have markets done after a 1 year out past the steep declines? So we took a look at 3 different scenarios. This is provided to us through Dimensional Fund Advisors. And we looked at what markets did after a 10% stock market decline, a 15% stock market decline, and a 20% stock market decline. And you'll notice after the 10% market decline, in the subsequent 1 year period, on average, since 1926, markets rebounded 11% on average. Over the subsequent 3 year period, they rebounded 11.86%. And in the subsequent 5 year period, 11.22%. By the way, that's average annualized return, not cumulative. So that's substantial. Let's fast forward. What about 20% market decline? A little bit closer to where we are or were, depending on when you're watching this. So after the 1 year, the average rebound was 14.21%, 11.58, and then 11.76 for the 5 year. So again, history suggests that markets have indeed rebounded in years past, and we believe they will continue to do so going forward. Now, moving along, what do we know about investing? Let's take a look at what economists, or rather, let's take a look at what we understand investing, so you can get clarity on what investing is really about. Number one is that investing means taking risks. Risk and return are related. So if you want to improve returns beyond that of, say, an FDIC savings account, there's an added risk of wanting to pursue that return. And there are many types of risk, but one risk would be the chance of decline in portfolio value. If you own a single stock, that stock could go bankrupt. We'd never suggest having very much money at all in a single stock, and we rarely deal with individual stocks. So investing does mean taking risk, but not investing means taking risk too. So what do we mean by that? Well, it does mean that simply if your money doesn't grow, then you may not achieve the lifestyle that you're pursuing. So if you want to retire at the age of 60, you may not be able to retire until you're 75. Or if you want to retire at 75, you may not be able to until you're 80. Or maybe you are accustomed to a certain lifestyle in spending that if you don't invest and your money doesn't grow, you actually won't be able to spend at that rate. You'll have to really reduce your costs, maybe not go on the vacations, get the nice car, give to the charities that are important to you, and all the things that might make life great. So indeed, not investing means taking risks too. The next thing that I think is important to understand is that markets do work quite well. So they're not as much as a casino as a very tightly coordinated group of people who are giving estimates on how much companies are worth. And the truth is that every day, there are literally millions and millions of people buying and selling stocks. And these people in aggregate are correctly pricing these companies as news and information becomes available. And the prices react the instant the news comes out. So as soon as you see news, it's old news because it's already been priced into the market. What changes prices is is news of the future that we don't know about. So we don't know, for example, what the government will continue to do to inject liquidity into the financial system. We don't know if coronavirus will be cured and then come back. We just don't know these things. We don't know when what will happen tomorrow, and we don't know what will happen weeks from now. But ultimately, when that news comes out, markets react to that. But the known news is already baked in. Markets work and embrace prices in markets. The other thing that another way to look at that is, well, should you guess where markets are going, or should you just take everyone's aggregate guess on prices? In other words, sometimes people will say, I think a stock is undervalued or overvalued, which is interesting because that means you would have to be smarter than the collective group of millions of people who are also looking at that stock. So let's look at this example here. What you see is a jar of jelly beans. You might recall when you were a kid, I know I do, my kindergarten teacher actually had a jar of jelly beans and asked the entire class how many jelly beans we think are in the jar. And everyone gave their guess, and the answers came out. I don't quite recall what the answers were, but I do remember the exercise. And this is important because if you do this in real life, what you'll find out is that the average guess, if you have enough people, the average guess is often very close to the actual amount of jelly beans that will be in the jar. And in this particular scenario, there was a financial advisor that did this test with his clients. And the range of guesses were 409 jelly beans to 5,365 jelly beans. The average guess was 1,653. The actual amount was 1,670 jelly beans, almost to a T, the exact of the average. And so if you think of that, it's exactly how markets work. We're all pricing stocks. Prices are accurate, in what they do tomorrow, will be the news of tomorrow. The next thing that I think is important to understand about investing is that you don't want to try to time the market. You don't want to try to get in and out of the market. And the best example of this in real life is, and I do this all the time, I rarely learn from it, and that is when you're driving down the highway, you're in the right lane or in the left lane, traffic starts to slow down, and you start thinking to yourself, gosh, I should be in the other lane. The other lane's going faster. So you wait, and then finally, you say, you know what, I'm going to jump over to the next lane. So you move over, and sure enough, within 15 seconds, your lane stops and the other lane you were in continues going forward. And then you kick yourself thinking, gosh, I should have stayed in the other lane. Well, I think we've all experienced that if we've driven a car, and markets are no different. We can sit here in our portfolios and think, gosh, I knew I should have been in technology stocks, or I knew I should have been in bonds, or maybe I should get in bonds now, or maybe I should get into international investments now. And again, we believe that that is the wrong thing to do, and we know from experience of looking at expert investment managers that trying to time the market just simply doesn't work. Getting in and out of lanes doesn't work. And we've got data on that. Here's data in front of you. What you see is Dimensional Fund Advisors, again, provided this information for us. And we're looking at 2,414 mutual funds. Mutual funds are just like a vehicle to invest in stocks or bonds, an easy way to do it. And we use them here at Covenant. There are 2,414 beginning in 1999. Each of these mutual funds is managed by a specific manager. And their goal is to outperform just a buy and hold index. And as we move forward to 2018, out of those 2,414 funds, by the end of the time frame, more than half of them had closed down. Only 42% of the funds that started were actually still even in existence, which is pretty crazy if you think about it, right? So only 42% were in existence. But even worse, only 23% of them actually outperformed, right? So we would look at that and say, wow, that's utter failure, right? These managers who are trying to get in and out of the market or try to pick the hottest stock actually weren't successful at all. In fact, you'd have a better chance at beating roulette in Las Vegas by just trying to select red or black at the roulette table. But the truth is that investing, if you're done properly, is very different from gambling. And we want to make sure that, again, we put the odds in your favor. So this is another belief in the facts support that you don't want to try to outguess the market. So how do we invest going forward, right? What's the best way to do that? Well, the first thing is we believe it's important to start with academic research. And the reason academia is a great place to start is when an academic writes a white paper, the first thing that other academics do is they read the white paper and they try to throw stones at the ideas. They try to break them down and identify problems with the hypothesis. That's a really good thing for investors, right? Because if you have, for example, Dr. Harry Markowitz here, who won the Nobel Prize in economics and actually sat on the investment committee for my former company, met him a couple times, brilliant guy, right? So when he writes a white paper, the first thing that's going to happen is other individuals are going to say, gosh, let me test this, or maybe this is wrong, or that's wrong. And that's a wonderful thing because you want to break down the ideas, build them up, break them down. And so suddenly you come up with such a good idea that there are very few people saying that idea doesn't work. And so that's where we want to get our information when it comes to investing, is the bright ideas of academics and in finance. And so all of these people, this is where we get our ideas from when building out investment portfolios for clients. Daniel Kahneman, of course, won the Nobel Prize in behavioral finance, in economics based on behavioral finance. Gene Fama, I've met multiple times and learned from him. He won the Nobel Prize in economics in 2013. And so you want a foundation, I think, of really bright minds who understand what it means to dissect information and remove good information from bad. So what do these folks say? Well, a lot of it was that markets really do work over the long haul. Of all the visuals that you'll see in this presentation, I believe this one to be maybe the most important. And what you're looking at is the growth of $1 from 1927 to 2018 in US stock index, and that dollar grows to $5,905 over that time frame. You'll also notice some volatility here, ups and downs, kind of like a little bit of a roller coaster, going in an upward moving position or direction. You'll also notice here, this is the Great Depression. But where on this chart do you see that $1 ever going to zero? And the truth is that it never goes to zero. Actually, markets in a diversified index like this never permanently lost money historically. Not to say that there won't be some sort of implosion going forward. I think we'll have a lot more to worry about if that occurs. But history has shown that markets have never gone to zero. But the problem is that people lose money all the time in markets. So why does that happen? Well, in my experience, in nearly 20 years, almost 20 years now, and professionally advising both financial advisors and investors, I found there were three reasons for it. Number one is that individuals aren't diversified enough. They have too much confidence in the company they work for. They have too much confidence in a product that they might use, and so they put too much money into that individual company. So they're just simply not diversified enough. And when that happens, if you have too much money in one company, it goes bankrupt, that's permanent loss. The second reason people permanently lose money is they try to time the market. So the emotions and behavior problems that we talked about before can coerce you to get in and out of the market at exactly the wrong time. In doing so, can be catastrophic for wealth. And then the third reason that people tend to lose money is because they didn't have a plan in the first place. They're sporadically putting money in places with no direction whatsoever going forward over the next 5, 10, 20, 30 years. And so the nice thing about those three reasons is that they can all be fixed. Number one, you can be properly diversified. Number two, you can be in a very disciplined long-term approach to investing. And then number three, you should have a plan in place. Everybody can have a plan. Most people don't, but you can. So that's the market. But what about these other lines? I'm going to focus here on a couple things. Number one is inflation. $1 is worth $14 now in 2018. So you'll notice that growth of the market certainly overcame inflation over that time frame. But the turquoise here, the $20, that's 1 month U.S. Treasury bills. hypothetically the safest investment in the world. And you'll notice from a quote unquote safety perspective, it's not very volatile. And this is probably a great thing to have during volatile times. And actually over the past several weeks, having very short-term, high-quality bonds has held up well, and that's what we've done in our portfolios. You notice it didn't decline during the Great Depression. So it's a great part of the portfolio to have. But remember, there are two types. There's risk of investing and risk not of investing, right? We talked about before. And what you notice here is that $1 only grew to $20. That's not nearly enough to keep up with purchasing the lifestyle that most of us need and want. And so the way we recommend investing for those who want to take on a little bit of increased risk is part of your portfolio should have stocks and part should have bonds. And determining those two components is paramount. It's probably the biggest decision you can make outside of diversification. So that's the first step. What's the right amount of stocks and bonds? The second here is that within the stocks, you should be diversified across many different countries here in the United States and in countries outside of the United States. So what you see in front of you is a map representing the world. Each country is in its geographic accurate location. United States, we've got United Kingdom, China, Japan, and of course our northern neighbors in Canada. But the size of the box here is not based on the land mass of the country, but rather it's based on the size of the country's stock market relative to the rest of the world. So said another way, the United States stock market in terms of total dollar value is 54%, roughly half of the worldwide stock market value. Whereas China is 3% of the worldwide value. By the way, this is as of the end of 2018. Japan, 8%. Interestingly enough, China is the same of Canada, which always surprises me when I see that. The point here is that across the world, there are a lot of countries to invest in, but there are also a lot of companies that are great companies. And if you don't have exposure to these other areas of the world, it means you don't have exposure to these other great companies. I'm sure you're familiar with names like Samsung, Shell Oil, Adidas Shoes, Michelin Tire Company, which we always buy Michelin tires on our cars because they're good tires and we have children and we want to be safe. Right? All of these companies are non-US companies. And by the way, the order of this is there's a reason for it. This is in terms of ordered from best performing country stock market to worst performing for the 10 years ending 2018. USA ranked 5. That's one of the highest they've ever been in the last 100 years. Greece is last. That's no surprise. They're often towards the bottom. And then you have countries in between. But the truth is that all of these countries' stock markets, we expect them to have positive rates of return over the long haul. But in the short haul, they may go up, they may go down. But we want to make sure we have exposure because we just don't know when or where those returns are going to come. So with that being said, how do we bring it all together? What does a diversified portfolio look like? So we took a look here at 7 different, what we call mixes of stocks and bonds outlined in front of you. So when talking to us at Covenant, we'll often talk through your investment policy statement and say, okay, well, based on the goals you're trying to accomplish, based on how much sleep you want to get at night, you don't want to worry about your portfolio declining so much, we may recommend the right mix for you. So let's take a look, for example, at the balance mix, 50% stocks, 50% bonds on this hypothetical portfolio. And you'll notice the 3 numbers here. The negative 20% is the maximum drawdown or decline of this particular portfolio since 1999. So I believe this drawdown would have been in 2008. So this 50-50 stock mix actually would have drawn down 20%. That's a lot. If you have $1 million, it's $200,000 that you see on your statement of decline, right? And by the way, the last few weeks that we've experienced haven't even hit these thresholds yet. So we know what the downsides are. By the way, it could go through this, right? But for the vast majority of economic scenarios, we'll probably end up somewhere in between these numbers. The middle number here, by the way, is the average return for these hypothetical portfolios over given time frames. So you'll notice if you move to the right, more stocks, but also more risk. Look at the downside here, 42% downside. So again, on $1 million portfolio, that's $420,000 decline. That's pretty hard to deal with, right? So it's really a 100% stock portfolio, something that makes sense. For most of our clients, we're somewhere around the middle here. So this gives you good perspective on what the drawdowns are. And based on the last few weeks, we're in historical norms. We're within this range. So with that being said, how long does it take for recoveries? Well, we don't know going forward how long the recovery will take, but we do know history and how quickly markets rebounded in certain situations. The most recent, of course, was 2008. It was the second worst drawdown on record that we have. And you'll notice several different lines. These are several different portfolios, mixes of stocks and bonds. The green line, for example, is 60% stocks and 40% bonds. Bonds, again, being much lower risk than stocks. Not no risk, but much lower risk. They tend to act as kind of the life raft of the portfolio in tough times, and they've done that as well over the last few weeks. So you notice the decline, 2008, the green line's dropping. We hit the bottom here, and then there's a rebound. And so if the decline starts in 2008, 2007, it rebounds by 2011 with this 60% stocks, 40% bonds portfolio. So that's several years of watching the decline and then the money rebound. But for investors whose time frame is really greater than 5 years or 10 years, it really shouldn't be an issue for the long term except watching it and having the heartache of that. You'll also notice the 100% stock portfolio in purple here, that declines a lot more and took a lot longer to rebound. In fact, it didn't even catch up with the 60% stocks, 40% bonds portfolio until it looks like around 2014, 2015. So stocks aren't always, the best thing to have. You want to have, meaning 100% stocks. You may just want to have the right mix. And so in this situation, again, markets rebounded with these given hypothetical portfolios. So that brings us to the next question. And should you do nothing or should you do something, right? What should you do? Well, the first thing is that you should be in check with how you're feeling. Certainly don't hold it in, call us. Say, hey, I'm scared about this, or I'm worried about this. I'm worried that I won't be able to retire at 65 or at 60, or I'm worried that, gosh, there's no end in sight. Help me think through this. If you're in check with the way you're feeling, then we can actually create, talk through it and maybe create a game plan to get you on track and make you feel good. What you're seeing in front of you is what we call the cycle of market emotions, and it's mirrors, I think, how a lot of people feel when markets go up and down. So, for example, if you think about, perhaps go back into the 1990s if you were investing then, we're feeling optimistic in 97, 98, we're getting excited, and we finally say, gosh, I'm going to get in the market. And so we get in the market at the peak, and then what happens? The tech bust happens, and suddenly markets are falling, we're concerned, we're nervous, we're alarmed, and now we're frightened. Well, look at today. Markets have done well for 11 years. And then suddenly the COVID virus hits and the temporary oil crisis had hit and markets start declining. And I think probably a lot of people are right here. What do we do? Well, what I've known is looking back is in history is the time to buy typically is when prices are lower, right? Emotion makes it hard to do that. But if you react to that emotion, here's what can occur. What we know about markets is that the best performing days in the stock market, when markets go up, they typically happen after the worst days. We just experienced that actually just yesterday with the market being up over 9-10% for the day, which is just a miraculous thing to watch. And the problem is that if you get out of the market, the likelihood that you're going to be able to time when to get in is very small. So you may end up missing 1, 5, 10, 25 of the best days because you were out. And what this chart illustrates is the destruction of wealth in trying to get out of the market, right, or being out of the market. So the first column here represents the growth of $1,000, 1990 to 2018. grew to $13,137 during that time frame. If you'd had your money in the S&P 500 index fund with no fees or anything here. If you missed the one best day, would have dropped to 11,773. You missed the best 5 days, 8,715. You missed the best 25 days, $3,281. That's all it would be worth. And look, your return is less than half of what it would have been otherwise. And so again, I think it's a strong indication or reason why we just don't want to try to get in and out of markets. Second thing that we should consider doing is what's called rebalancing your portfolio. And all that is keeping your portfolio in alignment with the target. So if your target portfolio is 50% stocks and 50% bonds, then we want to maintain that proper mix over time. So here at Covenant, we review portfolios on a regular basis, looking at them at least monthly. And if your mix of stocks goes in and out, and let's say suddenly over time you're now at 60% stocks and 40% bonds, what you want to do is we want to sell off your stocks that have done well and then buy bonds to bring your portfolio back in alignment. And over time, what that tends to do, at least historically, we've seen that it keeps your volatility lower, right? The ups and downs. Standard deviation is just a fancy name for how much up and down are you experiencing within the portfolio. And you'll notice when you rebalance, it really reduces, at least historically it has, the fluctuation in your portfolio. So in times like this, in times of crisis when stocks are falling, we don't want to guess about it. What we want to do is implement the process, focus on the process, and rebalance the portfolio to stay on target. The other thing that we can look at doing is something called tax loss harvesting. So inevitably, some investors may have losses with certain positions that you own. Well, you could leave them there until they rebound. The other thing we could do is sell some of the positions and then replace those positions with something not exactly the same, but somewhat similar. So it keeps you in the market, but we capture the loss. And the advantage of that is when you have gains going forward in the future, whether it be this year or in subsequent years, we can use that loss to offset future gains. And we outline in this example 2 investments where one investment had a gain that you have to pay taxes on. The other investment we sold, took a loss on it. That loss offset the gain, potentially saving, in this hypothetical scenario, over $8,000 in taxes. And so that's where, when we're making lemonade out of lemons, right? We want to look at that, and that's currently we're looking through that right now to see if there are opportunities for investors. And certainly it doesn't work for everybody, but it's something we want to look at. And then the final thing is we want to make sure you have a plan, not just an investment plan, but having like retirement cash flow projections. What does that look like for you? Have we accounted for your spending in retirement when you want to retire? Have we looked at all the things that are important to you? You know, sound financial security is a lot more than the right mix of stocks and bonds. And so we want to make sure we have that plan in place so you're going in the right direction. So with that being said, we certainly appreciate you taking time to watch the presentation. If you have questions, if you're a client, email us. You can email us at info@mycwa.com. We'll answer any of the questions that you have. We hopefully have answers. If we don't, we'll tell you that too. If you're not a client, if you're just looking to learn and you need help, let us know. We'd love to chat with you and see if we can help you. We may not be able to, but we'll tell you that too. And other than that, take care, you know, have the plan in place, stay disciplined, and we certainly hope that you stay healthy and occupied in the coming weeks. Take care. Bye.